I'm James Whitehead. I'm the CEO of the International Tree Foundation. We've been around for over a century, and there's a golden thread that runs through everything we do, which is around communities leading restoration. We do a lot of work in East Africa, and we're really keen on seeing the sort of multiple benefits of restoration for communities, for landscapes, and for the planet. Thank you.
Hi everyone, I'm Eleanor de Bierle. I work for Nattergal, which is a nature restoration company currently operating across England. We were founded 5 years ago now by several people, including Charlie Burrell, the owner of the Knapp Estate, which is a famous rewilding site that has been going on for about 25 to 30 years now, so you might be familiar with it. And our aim is to demonstrate that nature is an investable asset class. And so we currently manage and restore 3 landscape-scale sites across England and work across statutory and voluntary natural capital markets to fund the restoration.
Brilliant. Hello, everyone. My name's Luke. I'm the CEO of Nature Broking. Nature Broking is a carbon credit and natural capital intermediary and advisory company. So we work with predominantly medium to large-size enterprises, but everyone really from small companies down the road to the biggest companies in the world, in helping them build, understand, manage, and deliver long-term portfolios of predominantly carbon credits now, but other forms of natural capital assets. Our mission is to bring financial services rigor to the natural capital and carbon markets, and in order to be able to do that, we have to then, with the aim, of bringing in large-scale capital through the unlocking of demand.
And I forgot to introduce myself as well. My name is Ilse Rees-Hughes. I am the Associate Director of Communications for the Global Carbon Markets team at the Nature Conservancy. That is one of the largest ENGOs around the world, and we do take very seriously nature, of course, and its role in carbon markets. So with that, we have some questions prepared for our panelists here today, and I'd like to move into the flow of capital into nature, or lack of that. So what would you say are the biggest blockers preventing large-scale capital from flowing from nature into from markets into nature today? And which of those would you say are perception versus actual risk?
So if I was to take that to start off with, I think one of the major challenges that we have is we underpin everything. If we remove everything back, we have to ask ourselves, why isn't large-scale capital flowing into the market? Like, what is preventing that? And there are examples of quite a lot of capital coming in. And I think what we saw was that there was a trust issue with the market. The reputational risk associated with engaging with more broadly carbon markets, but nature restoration took a really big hit in 2023, which meant that there was the confidence went down, and that's a perception because it's not every market. It's just every project that you're working with. There's amazing projects globally that are continuing to do amazing work. But the real challenge, I think, is actually, as we all know, this is a classic soundbite, is there's not enough demand. But actually, when it comes to demand, it is about looking at what is the fundamental thing that's blocking wide-scale adoption of this. And in our opinion, that sits with accounting. So when you have carbon credit, you buy it and you use it in year, that it gets expensed to your P&L. So it is literally, by definition, a profitability penalty. Unless we can flip that incentive and start saying that, actually, this is an investable asset, this is something that sits on my balance sheet as an asset and not a profitability penalty, this market will never scale because it will always be deemed to be a profit penalty. And unless we solve that, everything else is kind of spurious around the edges. We're playing with little bits and bobs.
Maybe I could come in a little bit on the supply side, that there are quite significant challenges in terms of the complexity of accessing carbon finance for local restoration. I'm particularly thinking around the East African context. I'm a trustee of a charity called the Art of Forests, which is a network of restoration organizations around the world. And we've just published some research on, it's called Bridging the Disconnect, about just how challenging it is, just how complicated it is, just how expensive it is, and uncertain it is to try and access carbon finance for community-led restoration. There are some amazing examples out there, but I feel that I would call them the contortionists, those who have taken remarkable risks and had to do all sorts of backflips in order to access that finance. And so, on average, we found that sort of £250,000 was part of, you had to be putting that money in early on before you're seeing anything coming back in, and even then you're still facing uncertainty. So it's a really challenging from a supply side perspective as well.
And to add on to what has been said so far, I think there is a problem with the investment mindset towards natural capital, in the sense that organizations and financial systems are used to allocating capital towards grey infrastructure, not to natural capital, and they are not used to paying for the ongoing delivery of ecosystem services that nature restoration will provide, and they don't know how to actually record that and record the benefits that this will provide in terms of, for example, long-term risk mitigation. So the demand problem also comes from the fact that whilst companies are increasingly looking into their risks and dependencies on nature, they still don't know how to measure and assess their exposure. So what are the concrete risks to their systems? And how do you bring that case to your board or to your senior management team or to your CFO? And finally, what are the key points towards making the business case for nature? And then I think one other point to mention is regulatory uncertainty. And I speak from my experience working in UK natural capital markets, where we don't have a clear roadmap towards nature investment from the government. There's little clarity on the stackability of different natural capital markets, and I think that is definitely slowing the investment in nature, the access of natural capital markets to landowners, because they're not sure when the revenue is going to generate.
I do think that from what I hear, these blockers could be seen as opportunities as well, and really. I see that you've already started to tee our next question, focused on the demand side and the demand side behavior. So in that sense, how do you think we can shift that corporate behavior from viewing carbon credits really as a compliance or reputational building cost to really seeing them as long-term strategic investment and asset classes, like you were saying, Eleanor? How do you see we could get to that?
So I think the reason why carbon is still seen as compliance is because it comes last in corporate priorities. All around this conference and any sustainability conversations you'll have, the focus is on decarbonization, which is of course extremely important. But it's also very important to plan ahead and to think of your future budgets and your future carbon needs. And so we need to shift from thinking about carbon as a compliance or reputational cost to an opportunity to secure long-term supply, to then hedge against, for example, the planned future increase in demand for carbon, but also the future associated price increase, especially since we've seen the teething issues that the carbon market has had over the past few years and the reputational issues it has suffered from. And companies are very scared about what that can, the consequences to their reputation. And so they want to invest in high integrity projects, and those projects are not only scarce, they take a long time to materialize and to develop.
And I think to follow on from that, I'm going to do some participation, so forgive me, I'm going off piste here, but how many people, just show of hands, work in sustainability or sort of in and around the sector? I'd be very surprised if it wasn't the majority. How many people can explain what they do to their friends in a sentence? One hand, two hands? Okay, so we've got some good people. I think language is the real challenge here that we need to be solving, which is, I suspect for those sustainability professionals out in the audience, there's probably half an hour to an hour, depending on the organization, every 3 to 6 months that you get to speak to your board about new investments, new strategies, etc. And that follows everything with ES and G, so environment, social, and governance. And then there'll be a small proportion around carbon markets, investments in nature, etc. And if you've got that tiny window to do that in a sentence, which is the purpose of the kind of thing, is it needs to be made, it needs to be incredibly compelling, and it needs to be done in the language that they can understand. And so what we need to be able to do, in my opinion, in order to be able to scale these markets, is we have to translate an incredible project that James is working on into something that is very easily to be understood, which is risk, reward, and reputational risk to the company, risks that they're mitigating through this investment, and the potential upside from doing that. And if we can do that really effectively, and we can do it in our one sentence to our friends in the pub, and we pass the pub test, it will be much, much easier to see how, why people should engage with this market at scale.
And a follow-up there, Luke, have you, or could you share a little bit of how that has shown up in the work that both of your organizations have collaborated to bring in multiple actors into same value chain collaboration?
Sure. So it's very good, and very good to be able to announce this. So we are. So the SBTI V2 talks about bringing a value chain together. So working together with your value chain for Scope 3 emissions. And what we've done working with Nattergal is to bring together 8 companies from a large insurance company called QBE's supply chain. So their claims supply chain together for an initiative to purchase credits and invest in a very early stage project with Nattergal to help them engage with the carbon markets. But what we've done is bring everyone together in what we would call a buyers club. So you take, for those of you that know, the large buyers club that the hyperscalers have done, and we've brought that down to a medium enterprise scale level, which means that people can work together across their supply chain. This is an amazing initiative that showcases that competitors can work together where sustainability is linked, but also for QBE's benefit, what they're able to say is we are engaging our supply chain and we're creating stickier relationships. So this was a business decision for them, which was around, I'm doing this because I don't want to lose my claim supply chain, and even though they don't work together, like their competitors don't work together, etc., that means that they all wanted to work with that, because also the benefit for the companies coming into it is they get to be sticky to the people that pay them the money that pays the bills. It's a simple business transaction, and I think the impact of that is massive. And actually moving along supply chains, I'll stop waffling, moving along supply chains and having people work together where a top co-sponsors people within their, and organizations within their value chain, is incredibly beneficial, because they ultimately can provide the skills and the education to make it happen.
And to add on to what Luke said, I think from a project developer perspective, the importance of such transactions comes from the fact that they're providing us with capital upfront to actually enable the long-term restoration of our site. And that means that for them, they are able to communicate the ecosystem service benefits that are generated by nature restoration on top of carbon sequestration. So we can talk about flood mitigation through river restoration. We can talk about biodiversity uplift. And via the work that Nattergal is doing, we do a lot of monitoring and data capture. And that means that we will communicate with our clients and our partners annually the impact that their investment is having on nature and on local communities, providing them with a proper high-integrity storytelling angle to communicate with their employees, but also with their clients. And importantly, because the site is in the UK, it means that they can bring their clients, their stakeholders on site to visit, connect with the project, making it tangible for them and aligning employees with the company's actual sustainability goals and interventions and investments.
Oh, excellent. That's very interesting, and how that, yeah, you want to follow up?
Let's hold it nearer.
Yeah. So from that, I'd love to go to how those behaviors then compare to what is happening on the ground. And is there a mismatch between how investors are expecting to deploy these investments and how or what is needed on the ground and how it's actually being deployed and applied in the ground?
Yeah, I think that I sometimes feel like these are just such different universes and different languages and lexicons. I was speaking with someone yesterday who quoted someone who was Maasai saying, "When are the trucks coming?" This was someone who had been involved in the carbon project for quite a long time and thought there were trucks were going to come to somehow suck the carbon out of the trees. We're just talking about very different worlds in a way. And I'm also aware that there's so many risks. There's not just the sort of the hurdle of accessing carbon finance, but when I look at communities and what's important for them, it's making sure that that solutions are driven by communities, for communities, and that they have that benefit for nature and for livelihoods. And I'm just aware there's such a risk of sort of confusing incentives in terms of what trees to plant. I might touch on it later on. If we were to do some of the projects that we're doing now, and cost and carbon was the primary driver, how would that change the type of work that we do with communities? So I might hold on that for now, unless you want me to come in now with that.
No, I think you should come in now.
So we're part of a program with WRI, World Resource Institute, which is around restoration of degraded forest, planting trees on farms, and supporting livelihoods. And this is in key biodiversity areas, so really important for elephant habitat, and also really important as watersheds on which millions of people depend downstream. So if I was to be told, right, this has got to be a carbon project, and you're going to look at it from a business point of view, one of the things we would do is we would plant non-palatable species in the restoration sites. That is trees that elephants the leaves they don't want to eat. So we could create a sort of an elephant desert in order to maximize growth of trees. So that would be a problematic incentive there. We would probably lose the work we do on women's leadership in natural resource management and excess costs. We bring in threatened tree species into the mix because we know that they're really important, those which are on the IUCN Red List. It's more expensive, it's trickier, we'd ditch that too. Some of the livelihoods work that we do with communities around the buffer zones, we drop that. Fruit trees, grafted fruit trees, more expensive, ditch those. So there's quite a lot of things that we would not do or do in a very different way, which would benefit nature less, which would benefit communities less. The other thing we would do is we wouldn't support the setup and strengthening of community tree nurseries. It's cheaper to buy it elsewhere. So what we want to do is see that maximum benefit at communities, that multiplier effect. And the risk is with some carbon financing that we would make, or we would work with communities so that the choices which were made were less in their interests and actually less in the landscape's interest and less in nature's interest.
If I was to throw a counter argument out there,
you do that, Lou.
Say we would get spicy. So the counter argument would be: have any of your projects ever failed?
We've had fire issues.
Yeah.
And we've set up something we call the Trees Sustainability and Survival Fund. So we'll dip into that in order to replant the trees and get back to a good survival rate.
My point being really is that you've got a more resilient forestry project that is better and therefore less risky for the corporate, and therefore it would deterministically be valued more because the risk reward is higher. So therefore you should be able to make those finances. And I know that the TNC will come in on this heavily, but the second part is, if you take the work that Nattergal have done at NEP, actually when you have grazing herbivores, or not grazing herbivores, but herbivores who eat trees involved in a restoration program, a lot more carbon gets stored under the ground, and therefore if it's getting stored under the ground, you build, again, more resilient trees, but you also have a larger proportion of biomass. I'd just throw a challenge out there.
I think the piece about, so I don't use the word de-risking very often, but actually that strong community involvement is a massive de-risker in terms of survival rates and in terms of a project being successful. That's very true.
Yeah, from our side, definitely there is a point to be made about how involving communities from the get-go, giving them ownership of them having ownership of the projects, and looking at biodiversity. I don't want to say benefits, but the impacts that these projects have on biodiversity is a point to be made around durability for the project. It's a point to be made for resilience for the project, and that as a signal of high quality, high integrity, and then therefore de-risking of the project for investment. So I agree with that. So I'll move now from that to price, because I think that we've talked about supply, we've talked about demand, we've talked a little bit about behaviors and how investments are deployed. And I want to talk about how, or ask you, how does true or slash fair pricing look like from an investor's point of view, but also from the implementer's point of view, and if we are underpricing nature, or if we need to really decouple quality from price from quality when thinking about these projects.
So I think historically companies have understood carbon and their carbon footprint better, which is why carbon markets have been a way to channel private investment into nature projects. The issue with carbon pricing is that it's context dependent and location dependent. So for example, when you take a project in the UK, land use is much higher in the UK than land costs is much higher in the UK than it would be somewhere else globally, and the opportunity cost of land use is also higher. So like, how do you choose between restoring nature, farming, or building on that land? So the cost of the carbon the price of the carbon should reflect that opportunity cost. And that means that we need to have a mentality shift on the market where we can't, corporates can't expect carbon to have a single price globally. And the other issue that comes into this is the integrity of the project itself. So at the moment, because of market rules, we can't actually stack revenues across a land holding. So we end up doing something that's called puzzling. So from Naturgas perspective, that means that we're going to sell carbon from one area of the site and then biodiversity net gain from another, for example. And because of that, we have moved on to valuing the co-benefits that are nature restoration projects into the price of carbon, doing something that we call bundling. So we bundle ecosystem service benefits such as flood mitigation or water storage into the price of our carbon, which means that it's like higher integrity, and all of this is measured and valued by data. And our projects which deliver these long-term benefits are therefore priced higher. And that is a mechanism to price the long-term benefits of ecosystem restoration via carbon markets, because it's the best route to do so at the moment.
Maybe I could come in on price, and it's more about what's within the cost. So I'm very interested in the pie chart of how much is spent on the monitoring side, how much is spent on those who are sort of taking the risk, how much stays with communities, or how much is actually spent on the work itself. And so I worry about how much of that pie chart, that pie, is not being spent on nature restoration. And certainly, anecdotally, I'm sure there's reports out there which will say, some of those numbers are pretty shocking about how much money actually trickles down to doing the work. I've talked to quite a lot of people who are involved in carbon projects, or being biodiversity net gain, and government, private sector, and I've said, if it was your money, would you buy carbon credits or biodiversity credits, or do you think there's more intelligent ways, better value for money ways of spending that money to achieve climate impact or nature impact? And I'm yet to meet somebody who says, no, I'd buy credits. And I'm not going to do a poll on the room and say, to you, is that, if there are people here who care about the climate crisis, is that how you would spend your own money, or would you invest it in a way which you feel would have better bang for its buck? So there is an issue there around that pie chart and where the money goes, and the inefficiency within the current system.
I think to counteract that is that, let's take the work that philanthropy is doing. And again, apologies, getting spicy here, but have we slowed nature loss globally? No. Like, we've probably slowed it, but we've not stopped it. You know, the world is degrading at a rate of knots that's absolutely terrifying. We're losing 10 billion trees a year. That's a colossal number. And so we need to look at market mechanisms in order to bring in capital into this market. We have to bring in private capital. You know, if I was told, if you were to tell your pension fund, I want you to deploy capital into nature, and that will have the best impact in the world, but you don't get any interest from that. And you're not going to be, so you're retiring at 70, not 65 or 67 or whatever it will be at that point. The point being is that unless we can deliver return, we don't bring in private capital, we're not bringing in pension fund money, because yes, it might be the most amazing impact, but until we can create return and markets and create a market from this, we're just going to be still fiddling around the edges.
I might just come back there. I think in terms of, if I look at forests and deforestation, I think things like regulation like the EUDR and looking at putting boundaries around how companies operate, which there's some very extractive practices, that's really important. I think, you know, taxes on flying, for example, those changing those different market signals, you can then choose what to do with the money if for example, there's a tax around aviation. If it's Corsair, you don't necessarily have to invest that into credits. You can find other ways to create maximum impact.
But airlines, by its very nature, have got Corsair, which is a carbon credit program. So, you know.
But you could still have the same money coming in, but you wouldn't necessarily you don't necessarily have to spend the money in the same way.
I'll come in and say that at the moment, the system that exists really has space for all of these happening at the same time. And that what we've seen is that we're moving beyond thinking that there's just the one solution to more of a portfolio approach, where we take different approaches, where philanthropy can take more of those spaces, but also these projects being implemented can come into the carbon market space or the nature market space and take advantage of climate finance that would not come to these spaces if it wasn't for mechanisms like carbon markets.
I just wanted to bounce back on your point about like nature finance and other mechanisms. And so I think one of the important points we haven't touched upon much today is water. Water is increasingly critical to everyone, and this week is the perfect example of that. And it is important for us to find mechanisms to attract more private capital towards watershed restoration. And one of the key, I guess, blockers to that is that for carbon, we have a unit that we can all refer to. For water, there's no common way of determining the all-around benefits that watershed restoration creates in terms of mitigating flood risk, drought risk, but also recharging aquifers, for example. And so there's some work that is being done around that, for example, by the Flood Action Coalition, who are working on trying to find, on aligning around a unit to measure water-related benefits and then pricing that. But most importantly, getting stakeholders across catchments to work together to avoid the free rider problem and ensure that multiple companies, entities, and communities are benefiting from water mitigation and ensuring the long-term supply of water in supply chains and for communities as well.
I think I completely agree. I think water is the next big thing that is going to be from a natural capital investment. One of the major challenges there is actually, and again, accounting problem, which is you cannot capitalize green infrastructure in any way, shape, or form. And therefore, if you're a water company, it comes out of OPEX if you're doing nature restoration around a catchment area, and that gets charged to the customers, and customers don't want higher bills at the moment. And so what we're looking at is, if we go right down into it, is physically institutional blockers blocking this from wide-scale adoption. So if we can start, I don't know if there's any accountants in the room, if we can start lobbying and looking at ways in which we can remove those barriers, we'll start seeing, because people want to do something. Ultimately, companies are made up of people who have children, who want to leave the world in a better place. But we are fundamentally constrained by accounting principles, rules, etc., that prevent us from doing those things. And I think that's crucial.
So I think that in that conversation, we also started to glimpse at the business case and how to build that. So, because in the end, the price question also has to do with not only costs, but also what the delivery is. And so, in that sense, could you all speak to what or how can we build a stronger business case for corporate investment in carbon credits and in nature? And what can happen within companies, and what needs to happen in policy, and what needs to happen on the implementation side as well?
Do you want me to kick off? Sorry, everyone, you hear a lot of my voice. I hope it's interesting. I think the business case fundamentally, is, when we look at the carbon markets, is saying three things, or two things, which is risk and opportunity. So, there was a study done by McKinsey which predicts that in 2030 there's going to be a 3 to 10 times lack of available, credible supply for the upcoming wave of demand caused by Scope 1, 2, operational Scope 3 net zero targets. Now, what sort of credits can be used? The jury's still out. I mean, SBTI has come out and said it's only going to be long-term removals. There's some interesting work going on there, but nevertheless. So if that demand is coming, then prices are going to go up. So if we look at the forward pricing curves that we've looked at, there's a Bloomberg one that predicts that there's going to be a £62 increase on credits that are being purchased today compared to 2030. That is a significant risk to your business. Are you going to be able to afford the net of net zero? So if we start off with the CFO, are you committed to being net zero? Yep, absolutely. What's the price going to be in the future? And therefore, what's the cost of inaction? Okay, well, we can work that out. 2 is making sure that the projects that you're working with are the highest quality and they're the lowest risk. 3, we look at the underlying de-risking mechanisms. So to your point, do a portfolio. You don't put all your money into a single, I'm just going to go bet on SpaceX because, at some point their share price is going to tank, as it has. And so spreading your bets across multiple different projects is really important. And then finally is look at how do those things create real value? And ultimately, that's where some of the work that we've been doing is around how do you capitalize a carbon credit as an asset on the balance sheet, which we're happy to say has been done by a large corporate we've been working with. Then your business case is good hedge, financially prudent decision, completely de-risked, creates value. I've not mentioned integrity. I've not mentioned impact. I've not mentioned any of those things because in my 2-second soundbite that I get aboard, I'm able to say it's a prudent financial hedge, saving me money, it's completely de-risked, and it creates value.
To align with what Luke said, I think that the risk aspect is extremely important, and the basis of any business case will be data. And how can you prove to your boards that those risks actually exist, are material, and how you've actually come to that conclusion from a financial and operational perspective. And so there's now great frameworks out there like the TNFD or SBTN to help understand those risks, assess them so that you can then make that business case. And the case, I think, partially relies on value preservation as much as value creation. Like, we are increasingly suffering from all of these supply chain and financial issues that are material to companies. And so they need to be able to demonstrate that they will be able to continue to operate, so preserve the value that they have currently, but also create new values by identifying nature-related opportunities. And I think the value should not only be seen as financial value, but also as potentially social license to operate. So if I go back to water, for example, companies that are high obstructors might not get lots of support from local communities if they continue obstructing a lot of water in drought periods. But if they can demonstrate that they're also investing in restoring catchments to refill those aquifers, then maybe it gives them a storytelling angle that they can then bring to those local communities, engage them, and I guess that's aligned with what you were saying before as well.
Yeah, I keep on thinking about Thames Water, who's my water supplier, and how they've been quite happy with the market externalities, and how many businesses, actually part of their bottom line, has embedded externalities in it. So there are some challenges, and so I do go back to that regulation and creating guardrails for companies is really important, particularly those that are high polluters. I think, as you mentioned, there's a sort of range of options, and so I'm definitely interested in those non-market approaches. I think for SMEs, they're particularly less in need of carbon credits. They can look at other alternatives which they know deliver climate impact, and you can bring in the monitoring, you can tell a story, but you don't have to. It's a contribution rather than saying I've bought something. I've bought it and it's mine. And I'm aware that if you're buying carbon credits from Kenya, for example, that's coming out of their NDCs, their nationally determined contributions. So you're kind of exporting something there. I think there are ways which are non-commodifiable ways of dealing with carbon and nature, which are incredibly effective. So I'm not saying it's the only way. I think that it's good to have a breadth. And I also think around payment for ecosystem services, whether that's an imposed one to reduce the chance of having freeloaders saying, well, it's great that they're paying for it and we're not, but to invest that in ecosystem restoration so that it does create more durability. I'm aware that I was talking with someone from the company Lush about they're not involved in offsets, they're involved in strengthening resilience of their supply chain in areas like Uganda, Kenya, and actually a number of different countries around the world. And that's a pretty smart way to approach things as well. So it's not a one-size-fits-all, everyone needs to go for carbon offsets. I think there are opportunities there, and I think particularly for SMEs, they should be thinking about that really seriously.
Great, thank you. You want to go ahead?
Sorry, there's just one other point that I wanted to make with regards to UK carbon, which is the fact that there is, as we established clearly, growing demand for nature-based carbon in the UK, and companies are interested in purchasing UK carbon to invest in the country where they're headquartered, for example. The issue is that verified carbon in the UK is very scarce, and companies want to purchase verified carbon. And so a way for them to enable those local investments over the long term and avoid the capital drain that we're seeing with money going away from UK-specific natural infrastructure is for corporates to engage early and engage with those projects so that they can then talk about the wider nature benefits whilst being in line with, for example, their SBTi targets that Luke mentioned.
Okay, so those are the questions that we had for the panel, but I'd love to move into the Q&A portion of our session here. So I see some hands up. If we can have a microphone up here in the front. And I'm sorry if people out in the back can be very evident if they are raising their hands, because I can't really see over there.
Hello. Yeah, I have a couple of questions. I think.
Sorry, can you please introduce yourself?
So my name is Severin, and I'm currently setting up a trade association for people exactly like you guys, Nature Broking and Nature. So I'm currently talking to a lot of people, and therefore have a lot of questions. And so for me, and the CCC is speaking next, by the way. I don't know if you're aware. So nice to catch up with them too. So a comment from me is I haven't heard much about resilience and adaptation. And I think, talking to your boards these days, I don't know if carbon on its own cuts it. I think carbon is one half of the coin, and we need a much more holistic approach. So I think, there's definitely much more to think about in terms of how do we price all the services that nature delivers and not just carbon. And you talked about high integrity carbon credits, and I think that's really what it should be. Whether it's the right name, I don't know. And how do we move away from just carbon is really important. And to look how you were saying we need a change in accounting and a wider change to ensure that nature goes on the right side of on the balance sheet. So the question is, what would you need from government or from regulators or other stakeholders for that to happen?
So I think the honest answer is not much. And actually, as we see the left and right divide between nature and climate on the left, and obviously oil extraction, drill on the right. So we're seeing that split. And so I think working towards not looking for regulation is really important. Regulation is needed, full stop, and we want regulation. That has to be the end goal. But at the moment, I'm not seeing much regulation. So what do we need from government? Ultimately, we need government to provide a stable, clear, and compatible set of rules. that stay the same for a while, and the same with the frameworks, and the same with everything, which is how do we make this stable? Because otherwise long-term investments cannot be made. Because if we're having to go back to our boards every single year and say, well, sorry, someone changed something, so we're going to have to change our strategy, it's going to cost a bit much, we maybe made it wrong the first time, erodes confidence. We set ourselves the goal as an organization to get a climate skeptic to say that what we're doing is a good thing. And if we can do that, I think we'll solve some of the problems that we have, because then it doesn't become a left and right issue, it just becomes a straight business decision. So on your resilience point, yes, we've not talked about that. It's about quantifying risk. And if we can quantify risk effectively and say, if I mitigate this thing, it will save me, if I put 50 grand into a project here or 500 million into a project here, and that will save me 2.5 billion over here over the course of 3 to 5 years, why would we not do that? That is a straight tick box exercise, sounds great, but we have to quantify it in financial terms. So that's the most important thing. Is if I could give one bit of thing to come on, is quantify it in financial terms and then take that to your board from there. If someone wants to ask a question, I'd stand up.
Do we have any other questions out in the audience? Can't really see. Oh, I see one in the back over there. Thank you so much for standing up. Appreciate that.
Hi, my name's Libby, and I'm an accountant.
That is great to see.
We needed you.
That's why I stood up. I run a practice called the Ethical Bookkeeper, and I was a trustee and non-executive director of the Association of Accounting Technicians. I've had to park my journey to sustainability for the last few years due to family health issues. I'm only a small practice, but I'm quite visible. I was named Accountancy Personality of the Year this year, so some accountants, so female, and some accountants do have personalities. I want to know how I can get involved, and I want to know how I can help, and I want to know what I can take back to the AAT, because they speak to the government regularly. So whilst I may not be able to have the conversation right now with you, I want to make my presence known and that I am prepared to do something. I am trying to make changes. We have gold standard with the Fair Payment Code, and I'm literally in the middle of a conversation with Emma Jones, the Small Business Commissioner, and Xero, and been invited to speak to somebody at Xero on Friday because they're trying to put a report in place that people can verify their payment terms to be able to apply for the Fair Payment Code more easily. So if there's something I can do to help, I'm here to say, please get in touch with me, and I will do what I can.
Thank you very much. If there's one thing you can do is highlight that this can be done. This is not innovative accounting, the work that we've done with Clyde & Co. It's not a change. This is fully endorsed by the International Accounting Standards Body. It's working under FRS 102, which for the nerdy people out there is the private practice accounting standard, and it means that they've capitalized credits, so brought forward of an obligation as an intangible asset under FRS 18. If anyone's interested, but it's about highlighting it. This is not this has been done. It can be done. It's just people don't know about it, so it's an education thing. So if you can spread the word far and wide that this can be done, and there's case studies of large corporates who are doing this, that would be really beneficial.
Excellent. Get in touch.
And slightly different point here, but there's also many ways for you to get involved with nature restoration projects in the UK, whether through charity or through like credit purchases. Like we're increasingly seeing voluntary biodiversity credit markets popping up. And I have to put it out there, Nattergal recently launched our own program via Earthly. So they're a third-party company who are verifying the work that we're doing and are enabling us to fractionalize statutory biodiversity net gain units into smaller pieces that are then affordable for companies and individuals to invest in. And so if you, as a small or large business, or even as an individual, want to have an impact, then it's something that you can do as well.
I see another hand over here. Thank you.
Thank you. Hi, I'm Rick. I'm Senior Advisor on Climate and Nature for M&G. I've worked in responsible investment for 26 years. And I'm just a bit worried about this drive to prove that nature is a viable asset class. And I get the business case that if you invest £10 to save £100 from a flood, then that's it. But if you're making an asset class that needs to be tradable and their future investors need to keep getting it, and I think when we see what's happened from the markets and the state of the planet today as a result of neoliberal capitalism is a bit of a concern. And so if we're trying to put the solution back into neoliberal capitalism, is there going to be a risk? What are the unintended risks that you're not talking about at the moment? And I fully agree with the need for more regulation. And I think having watched lots of sectors voluntarily commit to X, Y, and Z and fail on those commitments, the need for greater regulation is clear.
Should I have a punt at that?
You crack on, I'll join in.
Okay. I think the answer is the system is broken. Like, fundamentally, I think we can all agree with that. The fact that you've got a company IPOing on 105 times their revenue, and capitalizing at $2 trillion is just ridiculous. The fact that there's a trillionaire in the world is utterly ridiculous. That's you could go to the moon and back, well, as he's trying to do. But I think looking at systems change, I think we're not going to, it's unlikely, I think, we're going to receive full system change without a massive shock. We thought that if we took the Strait of Hormuz as an example, that was a huge energy shock, and actually, I think someone calculated that energy shock would have paid for the entirety of us transitioning to net zero. So, there's a significant benefit here. So I think we've got to look at ways in which we can use markets to shift system change. I think of it like myself trying to lose weight, which is, if we start off with the position that I was in a couple of months ago, where I ate too much at Christmas, and then I looked at myself now, and I don't look at myself, but I don't look down every day and say, oh, okay, I've lost a gram or something like that. And I think what we need to be able to do, but I do look back at myself 6 months ago and go, oh wow, I'm different from that point now. And I think if we can do that slow, meaningful change towards a regenerative economy, then we'll start to see that systemic change happening. Sorry, it was a terrible analogy, but forgive me.
Yeah, I wanted to come in there. I think, so I worked with the Roundtable on Sustainable Palm Oil for a good while, and it's a voluntary thing, and it was deeply problematic, and the best of the palm oil certification schemes. There's this piece around sort of how capitalism works and sort of basic EQ 101 economics. I think we need to be really mindful of that there are externalities. People don't want to pay for them. There are freeloaders, and if you can freeload, you should. Is kind of how it is if you want to make a profit. So there are some real challenges right within it, and I think one of my worries is around London Climate Action Week. There's an awful lot of whizzing silver bullets going around, and the idea that markets can solve it is one of those silver bullets, and I think it's worth dodging that a little bit, saying yes, it's a really important part of it, but it's also a massive part of the problem as well. And I think we need to look at, so I'm just saying, worried about silver bullets, and there's a carbon bullet that's going around a lot here, and there's a market bullet that's going around a lot, and I just think we need to take it with a pinch of salt and say, what else is needed in order to address the climate crisis, and what are the alternative mechanisms as well for us to see positive change. I mean, I'd love to say that the work the International Tree Foundation does around planting trees and restoring forests is a silver bullet. It's not. It's I think it's a really important part of the story, but there's so many different ways that we can address the climate crisis, and different mechanisms that we need.
Yeah, and I'll just double down a little bit on the portfolio approach that I was mentioning before, and the fact that the urgency of the crisis at this point is we need every single tool. You can't really focus on just the one. Absolutely understand, and in terms of what you're saying, Luke, as well, about the system and systemic change. Systemic change takes a lot of time, and it brings shock, and that is okay as well. However, the crisis is not going to wait. So we need to take action now. And some of these mechanisms allow us to take action now in solutions like nature that we know work because they have worked for billions of years. And so that's an investment that can happen at the moment, while we also work in other solutions that also contribute to addressing climate change. So I do think that that's the idea here. It's like really taking a look at the tools that we have in our current box, using all of those, and then, but not thinking that we have all of the tools at the moment, that there are other tools that we might need to develop too. I think with that, we're coming to time. So I want to really thank, first of all, this fantastic panel and all of the contributions that you all gave us, and the thought-provoking contributions as well. Really appreciate you for taking time to be here today, as well as the audience here and your questions. Thank you so much. I really hope that you have a thought-provoking London Climate Action Week, and one that brings you from reflection to action, which is really what is needed at this point. Thank you so much for being here, and thank you so much.
Thanks, everyone.